All right, let's talk about something we all deal with, customer prepayments. You get a deposit, you book it. Simple, right? Well, in the world of Dynamics 365, it's not quite that simple. One wrong move and bam, your entire financial reporting could get thrown for a loop. But don't worry, today we're going to make sure that never happens to you.
I mean, on the surface, yeah, it seems easy. A customer puts in a huge order, they give you a deposit, you log the cash, job done. But here's the thing about a system as powerful as Dynamics 365. How you log that cash, that's what matters. It creates this ripple effect that can seriously mess with your sales tax, your AR aging reports, even your customers' credit limits. So let's break down the 2 ways you can get this done, the right way.
So, what you need to know is that Dynamics 365 basically gives you 2 main paths for handling these prepayments. And I want you to think of them as more than just different features. They're almost like different business philosophies. One is all about maximum financial control, while the other is all about speed. And they lead to totally different places, so picking the right path for you, absolutely critical.
Okay, let's dive into path number 1. This is what I call the formal route, using a prepayment invoice. I mean, this is the structured, totally by-the-book method. It's for businesses that absolutely need a perfect, traceable paper trail for every single transaction.
Think of it this way. You're not just, grabbing the cash. You are issuing a specific, official invoice just for the deposit. It's a formal request for payment. This creates a crystal clear record right from the get-go, and it directly links that deposit to the exact sales order it belongs to. No ambiguity.
Now, the beauty of this method is that it keeps your books incredibly clean. Since you're creating a formal document that the system ties directly to the sales order, you get a perfect audit trail. But here's the real kicker, the liability. That money you owe the customer until you deliver, it's held in a special, separate prepayment account. This is huge. It means your main accounts receivable doesn't get touched, your AR aging reports stay accurate, and your customer's main balance doesn't suddenly have this weird credit on it. It is all about precision and total control.
All right, so if the formal route is all about control, path number 2 is, well, it's all about speed and simplicity. We're talking about the direct route. This is for all of you out there who need to be fast, nimble, and flexible.
So with this method, you just skip the whole formal invoice step. It's almost like the customer hands you cash and you put it straight into the till, You just mark it as a prepayment, you're recording the payment directly in a journal, it's fast, it's simple, and it gets that cash on your books right away.
And here is the crucial difference, you guys. Because there's no separate invoice, that cash gets posted directly to the customer's standard accounts receivable account, so their balance immediately shows a credit. Now, this is way faster, right? And it's fantastic if you're dealing with, say, multiple small deposits and you don't want to create a mountain of paperwork. But there's always a trade-off. The downside is that it mixes that deposit money in with all their regular payments, which, can sometimes make their account history a little messy.
Okay, so there you have it. You've got the structured, control-focused formal route on one hand and the flexible, speed-focused, direct route on the other. 2 different philosophies, 2 different workflows. So the big question is, which one is the right tool for your business? Let's figure that out.
Let's put these 2 head-to-head so you can really see the difference. First, check out the document type, a formal invoice versus just a simple payment journal voucher. And the link to the order. It's required for invoices. The system makes you do it. But for direct prepayments, it's just an optional reference you can add. But really, the biggest difference, the one your controller is definitely going to care about, is the accounting impact. Are we talking about a separate prepayment account, or are we just lumping it into the main AR account? That single choice is what decides if the customer's balance shows that credit right away. Honestly, these are the differences that will make or break your decision.
So, what's the bottom line? It's actually pretty simple. You choose the formal prepayment invoice path if you absolutely need an official document for your customer, if you have to keep your AR aging reports squeaky clean, and if a rock-solid audit trail is non-negotiable for you. On the other hand, you're going to go with direct prepayments if speed is the name of the game. Maybe the payment isn't tied to one specific order, or you're getting a bunch of small deposits from one customer and you just want to avoid drowning in paperwork.
Now here's the thing, no matter which path you take, they both end up at the exact same destination, applying that prepayment to the final bill. And the good news? Dynamics 365 makes this last step a really clean and logical process, no matter which method you picked at the start.
So here's how the end game plays out. Step 1, you post the prepayment, using whichever method you chose. Then, down the road, you post the final full sales invoice. Now, this is the magic step. You apply that prepayment credit directly against the final invoice, and poof, it reduces the amount your customer owes you. After that, they just pay whatever's left, and you're all settled up. It's a really clean, straightforward journey to a zero-balance invoice, no matter how you start it.
The most important thing to remember from all this is that there's no single better method here. It's not about right versus wrong. It is purely about choosing the tool that fits your company's process. What do you guys prioritize? Is it strict financial controls and crystal clear reporting, or is it all about operational speed and being flexible with how you handle cash? Your answer to that question? That's what determines your path.
So, now that you've got these two powerful tools in your toolkit, I want you to take a look at your own operations. Ask yourself, are you on the right path? Could a simple tweak in how you do things give you a much clearer, more accurate picture of your customer liabilities and your overall cash flow? It's definitely a question worth asking. Thanks for joining me on the Explain